Gurus! More like guessers, the truth about market experts. Alright, let's talk turkey, people. You see these so-called market experts on TV all the time. They're dressed sharp, talk fast, and use big fancy words. They tell you what stocks to buy, and when the market's gonna crash or soar. But here's the dirty little secret, folks. Most of these gurus, they're just guessing. Believing every word they say can be a one-way ticket to Palookaville for your portfolio. It's human nature to want someone to tell us the answers, that magic bullet, that secret stock tip. But the stock market is a wild, unpredictable beast. If these experts were so good at predicting the future, would they really be sharing their secrets on TV? Or would they be quietly sipping margaritas on their own private islands? The reality is, their track record is often abysmal. Relying on them is like trying to navigate a minefield blindfolded. So what's an investor to do? Understand the game. These experts are often more about entertainment than actual actionable advice. Studies have shown that market experts are wrong more than 50% of the time. In fact, a study by CXO Advisory Group found that the average accuracy of expert predictions was only 47%. You might as well flip a coin or throw darts at a board. Bad calls, big numbers, the shocking stats on expert flops. You want proof? I've got proof. Booyah! Let's talk numbers because numbers don't lie. The CXO Advisory Group tracked thousands of predictions from market gurus. The average accuracy rate was less than 50%, less than a coin flip. You'd be better off asking your dog. These experts have research teams and data, and still, they can't beat a game of chance. The CXO study was comprehensive and long-term. Very few experts could consistently outperform the market. Most were just throwing darts, hoping something would stick. The Guru Dex study, associated with Hulbert Financial Digest. Mark Hulbert tracked newsletter recommendations for decades. Many failed to beat simple market index funds. Some performed spectacularly badly, losing subscribers money. The evidence is overwhelming. Most cannot predict the market accurately. So why do we keep listening? They're loud and confident, and sometimes, by sheer luck, they get one right. But the statistics are clear. Relying on these expert predictions is a losing game. Experts made thousands of incorrect predictions, leading to significant losses for investors. Wall Street whiffs. Even the big boys get it wrong. Now you might be thinking, okay, maybe those individual TV gurus are a bit shaky, but what about the big, powerful institutions? What about the Goldmans and the Morgans of the world? They have armies of analysts and supercomputers. Surely they get it right. Well, folks, prepare for another dose of reality. Even these Wall Street behemoths, with all their resources and brainpower, often swing and miss when it comes to market predictions. Take Goldman Sachs, for example. They put out regular market forecasts, GDP growth predictions, and stock market targets. But if you go back and look at their track record, it's far from perfect. There have been years where their S&P 500 targets were wildly off. It just goes to show, even with all that firepower, predicting the market is like trying to catch lightning in a bottle. Remember Lehman Brothers and Bear Stearns? They were giants before the 2008 financial crisis. Both firms made catastrophic misjudgments that led to their downfall. And let's not forget Enron, whose collapse was a result of massive accounting fraud and poor market predictions. These examples highlight that even the most esteemed Wall Street firms can get it spectacularly wrong. Who follow market experts often underperform compared to those who adopt a patient long-term strategy. What's their angle? The real game experts play. Let's pull back the curtain a bit, shall we? Why are these experts so keen to share their wisdom? What's their motivation? Is it purely altruistic? Sometimes maybe, but often there's more to it. They have their own agendas, businesses, and careers. Self-promotion is a big driver. To stay relevant, you need to make noise. Bold predictions get attention. If they predict a crash and it happens, they look like a genius. They'll be on every TV show, quoted in every newspaper. Many are also selling something, newsletters, books, or seminars. Their media appearances are part of their marketing. More attention means more customers. Their goal might not be unbiased advice, it's to build their brand and sell products. Follow the money. Before you act on advice, take a step back. Ask yourself, what's in it for them? Sell everything. The Andrew Roberts blunder of 2016. You want a classic example of an expert call gone spectacularly wrong? Remember 2016? The markets were a bit choppy at the start of the year. And then, bam! Andrew Roberts, a credit analyst at RBS, came out with a thunderous warning. He told investors to sell everything. Yes, everything. Except for high-quality bonds. He predicted a cataclysmic year for the stock markets. His advice made headlines around the world. Investors who listened to this high-profile analyst likely dumped their stocks. So, what happened next? Did the markets collapse as predicted? Not quite, folks. After a brief dip early in the year, global stock markets, including the S&P 500, went on a tear. The S&P 500 surged by over 9.5% by the end of 2016. Investors who followed Roberts' advice missed out on substantial gains, with some estimates suggesting losses of tens of thousands of dollars for average portfolios. This Andrew Roberts saga is a textbook case of why you should be incredibly wary of extreme all-or-nothing predictions from market experts. Brains versus the beast, why smarts don't beat market mayhem and your best move. Many of these market experts are incredibly smart people with PhDs in economics and MBAs from top universities. They've spent years studying financial markets and can build complex econometric models. But here's the kicker. All that intelligence, all that education, all that experience does not guarantee success in predicting the stock market. The stock market isn't a laboratory experiment where you can control all the variables. It's a massively complex, adaptive system driven by millions of investors, geopolitical events, technological innovations, and sudden shifts in consumer sentiment or government policy. How can any one person or even a team of geniuses consistently account for all these unpredictable factors? They can't. Think of it like trying to predict the exact path of every single raindrop in a hurricane. The market has a mind of its own, a collective psychology that can defy logic and historical precedent. Intelligence alone is not enough to tame the beast that is the market. So, what's the smart move for you, the individual investor? It's about recognizing the inherent unpredictability of the market in the short term. Focus on what you control: your savings rate, your investment horizon, your asset allocation, and your costs. Common sense investing, like diversifying your portfolio, investing for the long term in low-cost index funds, and rebalancing periodically, is far more effective than chasing the latest expert hot tip. Studies have shown that individual investors who stick to these principles often outperform market experts in the long run. By avoiding the pitfalls of market timing and focusing on long-term growth, you can achieve better returns than those who constantly try to outsmart the market.